Dylan Grice, finally we get you back. You were one of the first people we ever had on Real Vision. Everyone was like, oh my God, he's the smartest man in the world. And then you went undercover and nobody's ever seen you again. So tell us, give people a bit of background about you, where you've come from and what you're doing now, because it's been a really interesting journey.
Background from beginning when, okay, so I mean, I'm speaking to you here from Switzerland. So I've been over here for the last 6 or 7 years.
Yeah.
I left Soc Gen, where I've been a strategist on the sell side in banking, and I'd enjoyed that very much. It was great fun, but I needed to be doing and not just talking. And so I had an opportunity to do that. I had an opportunity to come to Switzerland and really help out with a family office out here, one of the largest family offices in Europe, a company called Equilibrium, based in Zurich. And they really wanted some help building what was initially an equity business, but eventually became the kind of multi-asset liquid allocation. So I kind of helped to build that, to establish that, to really kind of embed the investment philosophy that went into the investment decision making.
And how was that journey? I mean, because that's a big journey of discovery from the strategist side to now helping evolve a big family office and then evolve your skill set at the same time.
Right. So, I mean, I started out, very beginning of my career, I started out as an economist. I did economics undergrad. I did economics postgrad. My kind of ambition in life was to be an economist, right? That's how sad I was, right? That's all I wanted to do. And then, I know it's funny. It's funny now thinking about it, but it's true. And I kind of loved the idea of trying to kind of figure out where, actually why some countries were poor and some countries were rich. Some people were poor, some people were rich. So this was something that was very interesting to me as a kind of young adult. And so economics is the way to try and better understand that. And I kind of just ended up, I was at the LSE. Everyone at the LSE was applying for jobs in banking. And, I didn't know what an investment bank was. I honestly thought it was basically, when you go to a bank and you would cash a check and there would be someone behind the glass that was a teller. I kind of thought it was something like that, right? But they were all applying for banks. And so I kind of, without really knowing what a bank was, I thought I would apply for banks anyway, which I did. Got a job as an economist and ended up thinking, well, this is actually better than doing a PhD because I'll figure out economics and I'll get paid much better. So that was my thinking. And what I kind of rapidly figured out, it's not that I figured out how to do economics. I figured out that economics was kind of practically useless. I mean, for kind of, theoretical economics, for all kind of practical intent, is useless. I really, really believe that. You go from trying to predict the economy to trying to predict and unemployment to trying to predict markets, and this is just much more difficult and, frankly, much more interesting. And so I went from economics to prop trading, and I was kind of prop trader for some time at Dresdner Bank on the equity desk, and that was a lot of fun too. Unfortunately, they shut that down, which is when Albert hired me at Soc Gen. So I kind of went from, my whole career had really been, I started out as an economist, then went to be a prop trader, then went back to being a strategist. So there's this kind of oscillation between thinking and doing. And then at Equilibrium, it was lots of doing, but there wasn't much. There was a lot of things, but there wasn't so much kind of writing or speaking. So it wasn't such a big shift to go from a strategist to actually helping to build a kind of framework for kind of multi-asset allocation. It wasn't such a big difference. It's not as big a difference as it might sound.
Right. And then you were running a portfolio there, or?
Yeah. Well, so I mean, the first few years I built the equity business in inverted commas. We were a family office, obviously we weren't pitching for money, but I built the team, hired the team, hired a couple of analysts, managed the portfolio. But it wasn't so much, the thing that I always said to the guys at Equilibrium was that, one of the things that interests me is actually in building a process, building an architecture for thinking, right? For thinking correctly about investing, right? Is this kind of a good investment hypothesis? What makes a good investment hypothesis? How do we know that the investment hypothesis is wrong? How do we size positions? This was the kind of commitment that I made. Really was, I'll build you a team and build you a framework, if you like, that doesn't really need me to run it. So if I get hit by a bus, then you can still keep kind of cranking the handle. You've still got the kind of the philosophy is very firmly embedded. And so that was, that's what I went there to do. And that was fundamentally just equities. So we started out with an equity portfolio. That went quite well. So we then designed another equity mandate. It was a little bit different, but that also went quite well with the same team. And from there, there were a couple of kind of changes at the firm, but I ended up being asked to do what we'd done for the equity team, for the overall liquids team. So rather than just kind of, rather than being a stock picker, which is effectively what we were doing, we were now making kind of allocation decisions. How much between equities versus credit, right, versus rates, versus precious metals, et cetera, et cetera, et cetera, right? So, and this kind of played into something that I'm very interested in, which is that I think that even though domains are very different, so an equity guy might think that the skill set is very different from a credit guy, who might think that the skill set is very different from a macro guy or even from a quant guy. And on one level, yes, the skill sets are very different, but on a more fundamental level, the principle is the same. The principles are always the same. The principles are, do I understand what's going on? Given this kind of radical uncertainty, do I actually understand what's going on? Do I understand well enough to know when the odds are in my favor? And do I understand well enough to know when I've made a mistake? Right? These are the kind of fundamentals of any investment. And so applying those kind of fundamentals to an equity team wasn't actually so different to applying it to a multi-asset class team.
Now, you also kind of built a whole philosophy around how you think about investing. You spend a lot of time thinking about stuff and how, because you've now built a new business. So talk a little bit about that, and then your philosophy about what you're trying to achieve now, because I think it was very interesting when you and I caught up recently.
Yeah, so I think we're in the pros. I mean, we started Calderwood Capital at the back end of last year, and the idea is that it will really be kind of, there'll be two parts to the business. One part is the research side, and the other part will be a fund management side. Fund management's a much more difficult business to get up and running than research, and so we got research. Research went live last year, and that we're publishing a monthly newsletter, a relaunch of Popular Delusions, which is what I used to write at SocGen. Obviously it's come on a little bit in those years because I've had this kind of family office experience. This family office background has really made a very big, it's really had a very big effect on the way I kind of see things, really. So that's the Popular Delusions is partly kind of influenced by the practicalities of actually, how do you actually invest? You might have a view on what's going to happen to the world. You might have a view on what's going to happen to central banks or at the next election, or all of these kind of things. But how do you actually invest? How do you build a portfolio? And it's not just what's the trade. It's where do I put this in the portfolio? How do I put it in the portfolio? How do I size this in the portfolio? So these are more kind of practical questions that kind of interest me, and that's what the kind of research business is really about. It's really about trying to tackle those questions.
But you also come with it with a specific kind of deep value framework as well.
Well, yes. I think a deep value framework, a valuation framework, yes. You know, I think when you say you deep value, then it has certain connotations. And I think people think that it means that you won't buy anything that has a PE of more than 5, right? And I'm like, no, it's not actually what it is, right? But valuation, absolutely, completely, very, very value orientated. I don't know how else to think about investing if you're not actually kind of thinking about the expected returns, right? So yes, we absolutely kind of bring that to the research. But as I said, on the flip side, we are in the process of building an asset management business, and so the stuff that goes into the research, these are practical questions that we ourselves are trying to answer. These are questions that we ourselves are wrestling with, because these are things that ultimately will end up in the portfolio, or ultimately will influence the portfolio in the asset management business.
So you're in the process of launching an asset management business in basically a nuclear event.
Yeah.
So what I really wanted to do is pick your brains on how you are seeing this event, both from, using your macro perspective, of which, you're very good with that, but also what are the opportunities that it's throwing up as well? Because, there's two ways to look at this. There's a whole bunch of risk, as we know, but there's obviously a whole bunch of opportunity, and it's trying to sift through that I know that's really your strength. That's your skill set in all of this.
Yeah, well, I think, so there's two parts to that question. Where do we think this is going? And where are the interesting opportunities? And I think that the first one is actually a much more difficult question to answer, because I mean we all kind of have our views on where we think it's going, and I think you maybe we're not so different. I don't know. I'm very kind of concerned that we're about to see the kind of mother of all credit events.
Yeah, that's exactly my view.
It hasn't really kind of showed up yet, and I think that we've seen a huge kind of rally in the kind of really because of a relief and maybe even an optimism that these stimulus packages are just so enormous.
And also the narrative is now caught up, because it was so far behind the reality.
Yes.
So the narrative's caught up. And even Donald Trump yesterday saying, well, 200,000 people might die, he's now potentially even overestimating. Yes. So the narrative is now caught up. So therefore you can rally, essentially.
That's right. Yeah, I think, and we'd fallen so far so fast that, it's difficult really to kind of see how many sellers were left. So there could well be some kind of technical aspect to it. But yeah, it feels like the narrative is caught up. That's exactly it. And I think that you've had this kind of relief that the stimulus has arrived, that the stimulus is here, the speed with which the policymakers have got their act together compared to in 2008 when they seemed to take an age, and I think that the numbers are very big. So people are, I think, kind of relieved that the numbers are so big. For what it's worth, I just feel that there's, James Aitken's talking about these fiscal blockages, and it's just going to take a long time for this money to actually hit the economy. And in the meantime, we just fell off a cliff. So there's going to, those weekly claims were absolutely staggering. And so, since you asked, I kind of think nobody really, nobody runs a business. You might stress test your business and think, well, if things really, really go wrong, our revenues might be down 50 or even 60 or 70, but no one really stress tests a business for revenues to go to, down 100% overnight,
For 3 months. For 3 months.
For 3 months, right? So I have a suspicion that this pain is going to be substantial and severe. It is going to trip up a lot of these kind of credit problems. These credit excesses were already very, very evident.
And my fear within this is, if you speak to any market participant, the basic assumption is it's a 6 weeks to 3 month thing, and then we go back. But the problem is human behavior has changed. So the chances of people resuming their consumption patterns, their social patterns and other things quickly is low. The Prime Minister of Singapore made a really good point on this. He's like, look, we're going to keep our borders closed probably for a year, and we're going to have to get used to that, and it will affect us. And he said, I think this is probably a 1 or 2 year issue. Now, that's all well and good, but if you have negative growth, over an extended period of time, and you've got all of the debt to service, it's game over.
Yeah.
And that's all I think about. My thinking, I can simplify it all down to if people have sold the tail above 3 months, they're probably making a big mistake.
Yeah, I think related to that is the US numbers look completely out of control.
Yeah.
And you look at the measures they've taken, and they just they've not done enough. It seems to me when you look at when you rebase the kind of fatality count to once you've had more than 30 or 40, it's America's trajectory looks far more like Italy and Spain than it does China. And I think that I know from my own personal experience, we watched this, and by the way, I think we were, as a household, I think we were switched on to this, I think, before most. Not because I was particularly switched on to it, but because my wife was, Mona, who I think you know. And she got very worried very quickly about this. And we actually started stockpiling and cancelling trips. This was kind of back in late January.
Yeah, we did the same.
Right. And now I have to confess, I didn't really see this coming, but I did feel that this was one of those situations where it was probably rational to panic. Right. It wasn't irrational to overreact. It was completely rational to overreact. And the reason why we kind of came to that conclusion is because that's exactly how your immune system works. Right. There is a biological rationale to overreacting when you're faced with an enemy of uncertain strength. If you don't really know how strong the enemy is, there's no point in going in kind of, with a kind of half-baked defense or a half-baked attack. There's no point in allowing your enemy the chance to come back stronger. So you have to completely obliterate the enemy. You have to completely overreact. And that's exactly what your immune system does in the face of, this is how vaccine works. So I kind of felt, okay, Mona wanted to stockpile. I wasn't so sure, but, let's overreact. So we did all of this, and then we watched the numbers come in, and we actually started kind of getting a little bit nervous about it, a little bit scared about it. But it was all very abstract. And what then happened was it came to Europe, and then it was Italy, and then Northern Italy was in lockdown, and then suddenly it was all of you, and then it was here in Switzerland, and then suddenly we knew people that had it, and now suddenly we know people who died from it, and suddenly it's not gone from this abstract thing, it's gone from something very real. And that even when we saw it coming, that has actually been quite traumatic. And I just feel that that's what America is just about to go through. And I struggle to see really, I struggle to see the market doing okay when that hits America,
And I totally agree. But the weird thing is I think my wife's had it. She's in Grand Cayman, I'm in Little Cayman, so we couldn't get together. She's been quite ill, but she's over it now. We think a bunch of her staff got it. No tests. Now, the problem is she doesn't even know when she's safe to travel again to come over here. She doesn't know who she can meet and what she can do. Does it? And for me, do I have to reset the clock? Do I have to go into quarantine again? Even me going to the store is a nightmare now because nobody trusts each other. And I just look at the behavior already in how much has changed. And America's going to go through this enormously. And it's a real mental scarring for people. I know people, for example, in Southeast Asia who went through SARS have some mental scarring. But this is, clearly a lot bigger than SARS was. I just don't think people are factoring in some of the human behavior because, as you said, this has now gone from being abstract to a reality. And it's going to be a defining moment in your life that you will never forget.
Yeah.
And nor will any of the people around you. Yeah. That's truly extraordinary. It's kind of like a war.
Yeah, I think that's right. And so it feels as though, you're roughly 25-30% drop, peak to trough drawdown doesn't really seem to kind of match that type of, emotional scarring. And so that's why I feel that this probably, and I say probably, okay, because we're still on the first question. What do you think is going to happen? And I think that's right. I think that's actually the far more difficult question. And
Let me just ask you that because there's outcome and then there's time horizon.
Yeah.
So what is your view in how? And again, this is all probabilistic analysis. None of us have a clue. But best guess, how do you think this plays out in terms of what the market does?
And so my best guess, and I actually my very best guess, which again probably isn't worth very much, but for what it's worth, I think that as the US loses control of this, or is seen to have lost control, I think it's already lost control, frankly. And I think as over the next few days and weeks, these numbers, there will come a point where people see these fatalities and think, "Holy shit! When does this end? When does this end? When does this stop?" And I think that we'll probably see new lows then. And I think that at the same time, I think you will see the consequence of these fiscal blockages, i.e., not getting the money to the economy fast enough. I think you'll also see the consequences of what I think I could be wrong, but I don't quite see how you coordinate a kind of mass forgiveness in the credit markets, right? So you seem to, you're going to see, I think, an awful lot of defaults. As I said, these credit excesses were just there for all to see. Before this even started, back in January, you were with the investment grade, and even certainly with investment grade, I think even the higher quality junk, so the double B stuff, was trading at or inside the tights of 2007, 2008. So credit markets were ridiculously tight, and this was when you've had excesses all over the place. So you could see in the loan market the percentage of the leveraged loan market that was now just one grade above C. You could see in the private equity market all these add backs, right, where they were calculating their EBITDA for the leverage calculations in their prospectuses. They were allowed to add back projected savings. Right, so those EBITDA numbers were actually much lower than the ones that were being reported for credit purposes, which everyone knew about, and no one seemed to really care. So I could go on. The credit market was, I think, due quite a hard fall if it was given, a sufficient enough nudge. And what's actually happened is it's been kind of two open-handed palms right in the back, and it's just been thrown off the cliff. So I kind of feel that we haven't really seen the credit problems yet.
So is that usually when a credit cycle comes of this kind of potential magnitude, it's a 18-month affair. Yeah. It's not a 3-month, 6-month, even 9-month affair. Normally, it goes on for a while. What do you think?
Yeah, because once you default, then you lay people off, right? And then your competitors come in and kind of steal a march, and then it's actually then you've got all of a sudden you're having to restructure your balance sheet and restructure your business, and that you don't just do that in a month or two. And for all these, and again, I think this idea that this is only going to last for a few months or a few weeks even, those people that have been let go of, you don't just get a job straight away. So again, I can see why we could maybe be wrong here, and I certainly hope I'm wrong. But my feeling is we go lower here. I think that's kind of my best guess, and it's we're probably 18 months away from 18 24 months away from making new highs.
Okay,
to those highs.
Yeah, I think I'm even more conservative on this. I kind of feel like we might be because of the demographics and stuff like that, there might be a secular cycle at play here as well that concerns me.
Sure.
Because the baby boomers need to divest of a lot of this stuff, and a lot of it's credit and equity.
Yeah.
Comes out over time. So it's very spectacularly bad timing. So I guess we'll see how that plays out. So in that situation, where does the opportunity lie? Because it's difficult to short stuff right here. It's difficult to buy stuff right. It's one of these weird places that tactically, sure, we could punt around.
Yeah.
But to do anything meaningful seems complex.
So this is where maybe I kind of slightly diverge, which is that I don't have a problem thinking that the market's going to go lower, but still buying,
Yeah.
And I find it easier to be a buyer of this market than a seller. And the reason for that is, firstly, I think that the valuations actually now are starting to look okay, right? They don't look completely crazy. Now, I know that, I know the data points. I know lots of people can say, how can you possibly say that? What kind of idiot would say that when the, Shiller PE ratio is still in the top, quintile, and we're still the most expensive equity markets just about, over the past century. I understand those data points, and I don't really agree with them. I don't think that they're very useful. I think that there are some data points which are far more useful, and that they are actually flashing green at the moment. And I kind of give you an example. I think on Friday afternoon, in the high yield market, the implied default rate was over 20%. Right, so that's kind of you're looking at kind of maximum kind of default rates of about 12% in the tech boom for high yield, right? Around about 10% in 2008. You've got an implied default rate of about 20% in high yield right now. So that's kind of, it can go much higher, no doubt about that. But that's already there's some return there. There's some good return there. In terms of how does an expected default rate translate into an expected return? Well, again, it depends how you measure. But if you think about the credit, the credit spread that you get is effectively your compensation for being hit with some defaults, right? Obviously. Now, as that credit spread widens, you can absorb more defaults before you actually take a loss. Now, how much would defaults have to be for you actually to, well, we've already seen 22%. Let me ask the question a different way. Suppose defaults come in at the worst historical 5-year average rolling default rate, right? Which was, I think, it was actually early 2000s. The rolling average, something like, worst rolling average 5 years is about 10%. Even if we are about to go into that now, you're still going to make about a 4% return. Okay, now I'm not saying 4% is particularly spectacular, but under stressed scenarios, you make a 4% excess return over whatever you make in treasuries. Now, that's okay. I think that's okay. It's not completely, jaw-droppingly, mouth-wateringly fill your boots stuff, but that's something you buy. That's not something you look to sell.
And how do you size up the potential credit event? Because, it has a risk of being maybe a larger credit event than we have lived in our lifetimes through.
Yeah.
How do you get a grasp of that tail? Because that's the only way you can price this is, okay, this is what I think the tail is worth. This is where I think it's trading now. Am I compensated for that tail?
I think two things. The first is, I think it's kind of very, and it might be a little bit late now, or maybe not. I think it's prudent to have some of those things in your portfolio that people say only idiots have in their portfolio. For example, gold. Right, or Bitcoin.
Yeah,
which I know you're a big fan of. We've been we've actually spent most of that whole crypto bubble. We were actually living in Zug at the time.
Mona's in that world, isn't she?
She is. She did one of the first ICOs in Switzerland. I think it was the third ever ICO actually, and I think it was late 16, early 17. So we did get front row seats to that whole madness. And it was madness, and it kind of still is madness, actually. But it's something we kind of know a little bit about. I understand why people are squeamish about Bitcoin, but I don't think it's a dumb thing to have some. I think gold maybe is a bit easier for people to get their head around, although obviously a lot of people don't like that. And I think that, in the real kind of tails, the real extremes, I think those things should do very well. Assuming you avoid those tails, and you can have quite a nasty environment, a very nasty market without kind of society blowing up, right? Which is the kind of extreme tail that I think you go with Bitcoin. I think it's well, you want some cash, and how else do you think about that? Well, I said at the beginning, I don't have a problem thinking that the market can go lower, but still buying. The question is, how much do you buy? Suppose if you think that this is the bottom to the day, then you should go all in.
Sure.
Right? You shouldn't be hedging or screwing around. You should put everything in, because today's the very bottom, right? If you're not sure if today's the bottom, if you're maybe 50-50, then you should put half of your available capital in, right? If you actually think that this is almost certainly not the bottom and it's going to fall, it's going to crater, by another 20 or 30% from here, then maybe you would only put 10% of your deployable capital in.
So totally understand that. Makes total sense. So now you've got a set of opportunities. How do you filter which set of opportunities takes priority in the portfolio with the amount of capital that you want to deploy at any one time? Because this is where the dark art of portfolio management comes in. Yeah. It's never that easy.
Well, I think and this kind of relates back to the what we were just discussing about predictions about where we think this is all going to go. It's all very interesting. We all have a view on the future. We all have predictions. We all like to compare predictions. But I think that I find it easier to react rather than to predict. Right? I think reaction it's almost an easier kind of thing, because the market will ask you questions and you can answer yes or no, right? Whereas when you're actually kind of trying to predict and you're trying to figure out where it goes, then I think it becomes much more complicated. So when you're reacting, and I think these are the markets where you're in reaction mode. Do I like these prices? Do I like the price of this security? Do I like the price of this asset class? Yes or no, right? You can answer those questions reasonably easily. I think that it's too late to be looking for new investments here, right? You shouldn't be dusting down your file on that company you meant to have a look at 6 months ago because it now looks quite cheap. It's too late, right? It's too late. Either you know it or you don't. You should have been doing the work 6 months ago, right? You should have been doing, you should have been doing the work when you had plenty of time, when it wasn't a fast market, when it wasn't such a rapidly moving situation. That's when you should have been doing the work, whether it was for a company, whether it was for a security, whether it was some kind of slightly complex trade or a manager. Now is the time to be pulling the trigger on the work that you've already done. So in terms of how do you decide which one's which? Well, I think the filter is very easy at this stage. Have I done the work or have I not done the work? If I've not done the work, then I'll leave that for later, because right now, and I'm pretty sure it doesn't matter which market you look in. If you are a credit trader, you will see there will be some credits which you don't need someone to tell you, or that these offer great value. Why? Because you've been trading this stuff or watching this stuff for years. If you're an equity trader or an equity investor, it's exactly the same. You've already got your watch list. If you're a CLO trader, or if you're an allocator to different managers, you know what your universe offers you. And I think that at a time like this, it's a time to pull the trigger. It's not the time to be doing, new detailed analyses. I think, that was for kind of, that stopped in January.
So going down to the next level now, across asset classes, where offers the better opportunity? And another question as an addendum to that is, how the fuck do you deal with a portfolio where bonds don't work any longer as well? If you're constructing a multi-asset portfolio, Anyway, so the two questions is what asset classes look particularly interesting as we're drilling down, and how do you deal with bonds that don't really work in a portfolio or potentially don't?
Yeah. So I think the one that stands out on a risk-adjusted basis, I think would probably be CLOs. I think across the kind of CLO capital, when you get kind of a little bit more senior into the kind of CLO capital structure, you get to double Bs, you're getting a kind of double-digit return, 10, 11%. For double B. So that's obviously that's still sub-investment grade, but the kind of credit performance of CLOs versus the underlying credits is historically been incredibly good, far too good. You can normally, if you're willing to basically do your homework and accept the complexity that comes with CLOs versus vanilla credit, you're probably going up a notch, maybe even 2 notches in credit rating in terms of the expected defaults that you're likely to suffer. So 10 or 11% for, in kind of vanilla credit equivalent terms, triple B, maybe even single A. I just think that that's kind of phenomenal value. It is an opaque market. You need to know how to access that market. You need to know who the managers are.
And you need to understand it. It's not a simple market.
It's not a simple market, but, I think, again, as I said at the beginning, one of the things I find very interesting are these very deep principles, which are true across all. It doesn't matter what you're doing, right? The principle for Jim Simons and the scientists at Renaissance Technology, before they're actually deploying a model, the fundamental principle which they are deploying is exactly the same as the fundamental principle that Buffett and Munger would be deploying when they're allocating to a new business. Do we understand this? Right? Do we understand?
A lot of people don't ask that question.
No, they don't, but they should be. And that is, one of my heroes is Richard Feynman, the physicist, the Nobel Prize-winning physicist. And he was talking about doing science, and science is, in essence, is not so different from investing. It's trying to understand reality, right? And what Richard Feynman used to say was, just when you're doing science, just remember two things. Rule number one: don't fool yourself. Rule number two: you are the easiest person to fool, right? Always bear those two things in mind. And when you're doing investment research, it's the same. Now, yes, are CLOs complicated? Yes, they're not that obvious, but how much time do you need to spend to roughly understand the basics of what these things are and what the risks are? It's not rocket science. A little bit of patience, a little bit of kind of willingness to ask some dumb questions to people who know, and people who trade this stuff. I think you end up in the same place. If you're going to look at catastrophe bonds, or if you're going to look at life settlements, or if you're going to look at booking.com, right, or if you're going to look at Google, or Exxon, you're going to have to get down and dirty with really understanding what the hell is going on under the hood. And that, or if you're building algorithms for Jim Simons, right, you're going to have to do some pretty serious work, go down a bunch of dead ends, throw your hands up on multiple occasions saying, I don't understand this, I don't, and then eventually persevere and you'll get there. And so I think that, subject to a willingness to walk away if it's genuinely too hard or you genuinely don't understand it, right? Then, I think that spending time understanding how different investments work is just a very, very good use of your time. And it's a very profitable use of your time at times like this. When, as I said, you get dislocations kind of, I think in pretty much any market you look at, you can see dislocations.
Go back to that bond question, treasury bonds and that how that works in portfolio construction. Have you got any thoughts on that? Because a lot of people are just starting to scratch their heads and think about it. And do I substitute it with something else? Can I use gold in its place? How does that world work?
So I think it's kind of interesting. If you go, where do you start? Okay, I'll give you the simple answer. I think is this. And by the way, I haven't properly done the work yet.
Yeah, no. I'm just picking your brains on it because it's just come up very quickly for everyone. It was like, oh shit, okay.
It suddenly has, yeah. It's funny. But if you look at they've got, I think it's Deutsche Bank indices, but they actually have long put, long index hedges, right? So put hedged indices on Bloomberg. You can look them up. They've got them for the DAX, for the CAC, the FTSE, I think for the S&P.
And it applies a certain delta option that you buy every month or something of that sort.
I think it is, from memory, I think it's 5% out of the money, which they roll quarterly. It might be at the money, but I think it was 5% that they roll quarterly, right? So this isn't a particular. You could do far better than this if you just spoke to your bank and got them to kind of, rebalance it weekly or monthly, right? Because obviously, if you're buying a put option, in end of December, and then the market kind of goes up 20%. January, February, and then your kind of put option has, it doesn't actually afford you that much protection for a March drawdown, right? But nevertheless, that's what these indices show. If you look at the total return for this index and compare it to the total return of the DAX index, which is a total return index anyway, the difference over the last kind of 20, again, it was a few weeks ago I looked at this, but I think it's round about 20, 25 years worth of data. Right, the difference between a fully hedged index and just a naked index is 90 basis points. In other words, it only costs you 90 basis points to hedge with a put option. Now, if that's the cost of hedging a full equity portfolio, I think that I would rather have a portfolio of puts in my portfolio than to hedge my portfolio than 40% than the 60-40. Well, 60-40 basically just is dampened equity, right? I can dampen my equity.
Well, because they were both correlated, so you got the double kicker, so it made everybody with an all-weather fund look like a hero for a while, right?
Although historically they haven't. That correlation has not been stable.
No, it's not.
It's really so that there is a potential kind of disaster where actually, you basically get this, you don't get the hedge there when you need it, right, from the bond market. And if you've got the leverage risk parity, then you're clearly in trouble. But again, subject to having to actually broaden that type of analysis, but that's quite promising, right? It only cost me 90 basis points through the cycle to hedge 100% of equity portfolio with put options, with vanilla put options. I think that could be the answer. That's what you do instead of bonds.
Yeah, I mean, it's super interesting. What's the variability of returns? Because it's very easy if you're in a family office to say, well, 90 basis points over that period of time is fine, but if the variability of the 90 basis points is, 1 year you're lagging by 10%, this in this stupid business nobody will accept it.
Yeah.
Do you know anything about that or not?
I mean, I think the volatility was less, the drawdown was lower. I think that the question you ask is such a good question, and I think for any money manager, it's just it's if you had answering that question is the holy grail, because it's not, you're asking that question for that particular strategy. You could actually ask that for anyone who thinks they might outperform for a couple of years. And I think that the answer is to the extent that there is one, is I'd say two things. One, education. So be as crystal clear as possible with your investors about exactly what you're doing and exactly what they can expect, so that when it does happen, you can tell them and it's not a surprise. That doesn't guarantee you anything. I think it might buy you an extra year of underperformance, but that can keep you in business. And the second thing is, deliver what you promised. So if you're kind of trying to educate, you're trying to promise investors and say, look, here's what we really can outperform over the cycle, but there could well be 2 or 3. If we follow this exact strategy, we would expect, 2 or 3 years of underperformance every 10 years, right? I think if you can really get that, don't sell them something that's not attainable. Don't sell them, constant outperformance and without any period of drawdown, without any period of underperformance. This doesn't work. And bizarre, you do see people do it because I suppose it sells. But this is this is the asset gathering kind of strategy, right? Where you have like kind of 20 funds. And you tell the kind of investor that every single one for every individual case, you say, oh, this one's just going to outperform forever. This one, right? And of course, most of them don't. But just statistically, 1 or 2 of them will do. So they're the ones that get all the inflows, right? And
then they stop outperforming. Yeah.
So yeah, I mean, I don't have a better answer than education, deliver what you promised, and and kind of hope, really.
So let's get down to more specifics now. What are the areas that you're focusing on? So CLOs, that's an area that takes, as we talked about, more of a skill set. In equity terms, is there kind of particular sectors that you're looking at, or are you very, very special situation, single name driven? How are you looking at this?
What kind of interests me? I think that I think that some of the emerging markets are kind of interesting. I think that a lot of emerging markets were interesting before this happened, before we had this recent kind of episode. I think Russia's been interesting to me for some time. We've been invested in some Russian equities. Sberbank in particular, I think, is
what's interesting about Russia for you, because it's a market that people fall in and out of love with.
Yeah.
As far as I know, most people aren't involved any longer.
Well, so that's already a part of the answer.
Yeah, I figured that much.
I think so. Russia, to me, is not. It's not a view on Russia as such, right? It's not a kind of macro call on Russia. It's just that like any index, there are, I mean, to varying degrees, but any equity index has got, good companies and bad companies, and well-run businesses and badly run businesses. And Russia has some very well-run businesses, some not that many, but it's got some well-run businesses. And one particularly, I think they have one of the best-run banks in the world in Sberbank, which is a kind of fortress balance sheet, unassailable position in the Russian market, without kind of spending 20 minutes with a kind of articulation of the investment thesis, I think this is about as bulletproof as you get as far as banks go. It's kind of like the JP Morgan of Russia, and that you have a very rickety banking system. Every time there's a downturn, the banking system gets crushed. And when people do pull their money out of banks, when there are runs on the banking system, they put their money into Sberbank, right? Because it's the last man standing, it's the highest quality name. So in terms of the problems, the structural problems that banks have, i.e. bank runs, Sberbank, if anything, benefits in that kind of environment and gets stronger in that kind of environment. The other problem that banks have is this kind of structural mismatch between their assets and liabilities. So they've got very short-term liabilities and deposits, but they've got kind of longer-term assets in terms of mortgage loans. And this often kind of eats into equity when there's shifts in relative interest rates. Most emerging markets, and certainly Sberbank, they actually lend floating rate, so they don't have that mismatch either. So they have a very, very kind of robust business model, very, very robust brand in Russia, and they have extraordinary margins. Emerging market bank margins are far, far wider than they are in developed markets, because you don't get the same competition from capital markets. So emerging market banks, I think, are kind of different animals than their developed market counterparts. You've got a bank that's regularly earning in excess of 20% return on equity, and it's trading at a 20% discount to book value. So I think that you're getting very, very good. From that's very, very easily a double-digit return, in my opinion.
Have you come across the family office? I won't mention their name. That only does this. They only do emerging market banks.
No,
and they amazing. I should introduce you.
Yeah.
Amazing. I mean, it's a big family office. They've made a fortune, but basically they only focus on emerging market banks. There were the Nigerian banks, the Indian banks, the Russian banks, and all of this. When nobody else is looking at them and everybody's puking them, they're the guys who go in and figure out what, because it's kind of one trick that they know really well.
Well, it's something that I discovered when I was at Calibrium. One of the analysts that I had, incredibly switched on, brilliant analyst, brilliant investor, and he was the one who basically educated me on emerging market banks, and he'd come from an emerging market background, and I think I had many of the prejudices that we all have about banks. So they're structurally unsound business models, structurally leveraged business models. You don't make a good business better with leverage. That's just banks. Always blow up during a crash. And of course, every single one of those kind of things has an element of truth to it. But it's not quite the same in emerging markets, and
it's also what discount you got when you buy them, and what the tailwind is. Many of these emerging markets have great demographic tailwinds. For example, anything in the Middle East, for example.
Yeah, although not Russia.
Not Russia. It's the opposite. It's a demographic brick wall.
Yeah, real problems there. But so I said the Sberbank is something that we own personally in our own portfolio. But in terms of what I was saying earlier, I knew this business, I knew this company, and I kind of been invested in this bank on and off for several years now, ever since the crash in late 2014. So as I said earlier, you should be buying what you know here. You should be doing new work, right? So some of the other things that we knew, I've actually one of the things that I think we did quite, I suppose we pivoted for value investors. We actually got quite bullish on tech stuff some time ago. We kind of got comfortable with we got comfortable with the idea that things which are optically expensive are not necessarily intrinsically expensive, and so we did get some good. We did quite well with some tech names, some growing names. Effectively, we were buying some growth stuff, and I think that some of those names just got absolutely smashed, and they're now kind of trading at not necessarily the headline Facebook, Amazon, Google, but you go down a rung. I said Booking.com. I think that's a very good example of a company with just absolutely bulletproof. Balance sheet, bulletproof as you get, business model, kind of just throws off cash, dominates its market, and is still getting double-digit growth, and it's still going to be around when this corona thing wears off. And again, I look at that and I can see, on a prudent case, I can see double-digit returns on a kind of 5 to 10 year view. I think more likely you're pushing kind of 20% returns. So I think that when you're looking at some of these names, some of the things that, so I said that's not CLO.
Sorry, when you say 20% returns per annum, you're talking about over a period of time.
An expected annualized return of about 20%, right?
Yeah.
So I think first select names that I know, I'm looking at 10 to 20%. I think, and that doesn't mean that in 6 months' time they won't be an expected return of 30 or 40%, right?
Yeah.
But, it makes sense to buy them now. It makes sense to say, actually, that valuation works for me here, and therefore I'm actually okay. Yes, I'm scared about how far this goes. Yes, I'm scared of a credit event. Yes, I'm scared that actually when the shit really hits the fan in the US, there's going to be a mass panic. I get all of that, but there's still enough for me to be doing right here.
But that works PA and it works in a family office, but in an asset management business that doesn't work, right? Because most people can't afford to take pain for a period of time. Pain is, as we know, all of the greatest macro traders in the world can take extraordinary pain because what they're looking at is the risk versus the reward, and they understand that.
Yeah.
But the average investor invests in an asset management firm who's taking bets like that. It's hard to do. How are you thinking of that?
Well, we haven't got our asset management business set up yet, so it's very easy for me to talk about it, before you're actually doing it. But I think, what we're in the process of building is a very diversified fund of funds. So we will be looking at fundamentally diverse asset classes here. Equity will be a very small slug of that, probably less than 10%. My partner in this is Rentec, so he will be doing a lot of the quant, helping with some of the credit, but we'll also be, spending a lot of time on, I think, more kind of niche areas of credit, more niche areas of the loan market. Some of the different, the insurance market is older than the equity market. Phenomenal opportunities in the insurance market, whether it's catastrophe or whether it's longevity, whether it's mortality or morbidity. There's all sorts of very, very unique return streams that you can pick up with varying degrees of liquidity. So in a situation like this, I think the answer is you don't just want to hedge your return profile, so that you've got genuine correlation. And by the way, having a portfolio of developed market equities and emerging market equities, that's not a diversified portfolio, right? That's just an equity portfolio, right? And then if you put 60-40, so you get 40% bonds, and you've still got basically an equity portfolio. So that's not diversification. If you want real diversification, you have to just move completely away from equities. And I said that's kind of one of the things we're doing. But the other thing that you have to have diversification of, it's not just the return stream, it's the liquidity. So you can't have, well, it depends. If you've got, say, a very kind of, suppose you're investing in a bunch of different managers who do lots of kind of different things, but they're doing quite esoteric things. So they need time. You can't just redeem on them and say, I need my money at the end of the month, right? They need 12 months to get your liquidity back. And if all the managers are like that, then you've got 12 months, effectively your fund will be offering 12-month liquidity because the managers that you're invested in are offering 12-month liquidity. The problem is, in a situation like today, there's absolutely nothing you can do. You can't take advantage of any of these dislocations because you have no liquidity in your portfolio. So what you have to do is diversify your liquidity profile as well. So if you've got some uncorrelated assets can also be very liquid. Two good examples would be systematic traders, quant traders, trend follows or mean reversion, whatever they're doing, and catastrophe bonds. Right, catastrophe bonds obviously doesn't kind of correlate with the broader equity market, but you can get rid of these things in a couple of weeks' time. So here's two sources of liquidity that, if they're doing their job properly, and actually catastrophe bonds absolutely have quant, doing what they usually do, you would have firepower, you would have liquidity to allocate to some of these dislocations, whether they were in CLOs or some of the kind of NAV discounts in the unit trust market, et cetera, et cetera. So it's not just about diversifying your return stream; it's about diversifying your liquidity profile too.
There was one area I still wanted to talk to you about, because I know a lot of the people on Real Vision have looked at it. We've had various people on, which is uranium. Just love to get your updated thoughts of where we are with that.
Yeah, so we've actually just invested a bit more in that idea. It's something that we came across a few months ago. I'd heard about it. I hadn't properly looked at it. I spoke to the guys at Segra. I spoke to Adam and Arthur, and really spent a lot of time with them. And they kind of talked me through it. Did some reading, and just it's just such a no-brainer. Nuclear is a no-brainer to me. So I thought that nuclear was, well, I still think that nuclear is a no-brainer. So that's the first thing. What does that mean for uranium? I thought uranium was very, very attractive late last year. I think very, very clear deficit in the market. Since then, we've actually seen, we were seeing already a lot of mine shutdowns and mothballing of capacity. We've just seen Cameco shut Cigar Lake. I think we saw another big shutdown as well. I really feel uranium is, I think this would be more kind of event driven. But I would view this more in terms of the optionality. But I kind of look at uranium and see a kind of 5 to 10x, over the next few years here. So I think that I think this is just a great time to be investing in some of these places. Again, do you know how to do this? Do you actually know how to value a mining company? Do you know how to value a mining junior or explorer? Either you do, in which case great, you go and do it. Or you don't, in which case find someone who does. Right? Someone somewhere should know what they're doing.
Yeah, true. It's a complicated world. I mean, I was short the HYG just because I wanted an easy way to hedge. And then, it fell out of bed and I made a bunch of money in it. And then I asked myself, the question is, do I even know what's in it? I'm like, well, at this point, I'll have to leave it to somebody like Dylan, who's going to do the homework. That was my macro view, is this is probably going to fall. I'm like, now it's time to give it to somebody who's actually going to do the work to know whether, I'm stupid by doing this or not. And you can take opportunity without being deep by having a view. Like you're saying, your clear view is nuclear is the answer. Therefore, is there an opportunity to take that bet that's cheap? Which it probably is.
Yes.
And then after that becomes complicated is how do you structure a trade like that?
Well, I think that's right. But I think, again, I should say, if you don't know how to do that, find someone who does, right? But if you're going to find someone who does, you've also got to know how to spot someone who is legitimate when they say they know what they're doing versus someone who is not legitimate. Because nobody, if you sit in front of a fund manager, right? You're not going to find a fund manager that says, I'm Mr. Average. I don't really know what I'm doing. We don't pay that much attention, frankly. We just kind of, give us your money and we'll put it to work and, fingers crossed. You never hear that. But frankly, that would be the correct answer for a lot of them. So you have to kind of, there's no substitute ultimately for doing your homework. If you're going to get.
And I do think that it feels to me that the future of this industry is a rejection of asset gathering and more about specialist expertise.
Yeah, I kind of hope so, but I'm not so sure. I'm not so sure because I think people have very, very short memories. I really think people just chase returns ultimately, and it's such a strange industry. Finance is such a strange industry. If you're making mobile phones, then obviously you want customers or prospective customers to look at that mobile phone and to hold it and to feel a connection to it and to enjoy the experience of touching it and really feel a connection, really like this mobile phone. Aesthetically, this is a beautiful thing, right? That's what mobile phone manufacturers do. That's what car manufacturers do, furniture manufacturers, pretty much everything. If you're an investor, if you've got a portfolio that really looks great and it's got all the stuff that everyone loves, it's going to be a disaster, right? The only kind of portfolio that's really going to generate decent returns is going to be one that kind of makes you want to puke, and that right, and that doesn't sell, right? That never sells. No one wants to puke when they look at a portfolio. So I just think this is kind of a structural quirk of the industry. That it's just.
I can't wait to see how you're going to market this fund. Well, look, I've got a portfolio. It's going to make you want to feel sick. You're going to call me an idiot, but then you're going to give me some money. That's the pitch, right?
Yeah, you could. Maybe I haven't thought this through.
It's all right. You've got some charm. You'll get through. And if you use your Scottish accent broad enough, they won't understand a word you're saying anyway. So Dylan, thanks for that. The next bit we're going to do is we're going to do a series of fixed questions. We've kind of done this before on Real Vision, I think with you in the very early days. It's called the intersection.
Okay.
Is there one person, living or dead, you would want to interview more than anyone? If so, who and why?
It would actually be Jim Simons. I was going to say Richard Feynman, who is a hero of mine. In many ways, Feynman kind of had a bigger impact on the way I think about investing than any investors. And as I said, I really think that science and investing are actually cousins. I don't think that they're as far removed in principle. In essence, they're not so different. The subject matter is radically different, but in essence, they're not so different. But I wouldn't be able to have much of a conversation with Feynman about theoretical physics, and I'm not sure he'd be that interested in finance. Whereas, Jim Simons is both, right? He is, he's a brilliant guy, but he had a brilliant career as a mathematician. He won the what was the Veblen Prize for geometry, age under 40. He assembled a team of code breakers for the NSA. And now he's assembled this team of code breakers who've kind of cracked the market. So this is a guy who does understand finance and he does understand markets, but fundamentally he understands science. And I just think that would be a mind-blowing conversation.
Yeah, totally agree. Okay, next question. What is the book or books that have changed how you view the world, and how so? And also, what are you reading right now?
The books that really changed the world, indeed, for me, these are always kind of funny ones, because something that had a huge, books that have a big impact on you are really very much a kind of function of when they hit you.
Absolutely right.
And so you can kind of say, well, for me, a book that had a huge impact on me was Taleb's Fueled by Randomness. I really, I'm a huge, I know he's not to everyone's tastes. I'm personally a huge fan of the guy. And when I kind of flick through that book, and I find that there isn't really much in any of the chapters that kind of surprises me, or that I didn't know, or that I don't know, and not anymore. But it was almost like the first time I read it, a light went on. So the fact that I can look at it, and I'd been in this dark room, and all of a sudden someone had just switched the light on, and this kind of the central foundational role of irreducible uncertainty. This is central to kind of everything that I do as an investor, and everything that I kind of think of as an investor. And I can trace that back to Taleb, really. And the fact that when I kind of look look at the book, and I almost there's nothing left to absorb. I think I've kind of absorbed it all so much. I think that's testament to just what a bigger impact it had on me.
Yeah, and it couldn't have been a better book for now, right? I mean, Christ, this was a black swan and a half.
Yeah, completely. 1 month. The world changed in 1 month. It's just phenomenal.
Okay, next question. As an individual and as a leader in your field, how do you stay engaged and relevant in a world that's moving so quickly?
Well, engaged is easy. How do you stay relevant? Jesus. That's a tough. I don't know. You just hope, I guess. I'm not. I mean, how do you stay engaged?
But I mean, basically, how do you stay on top of where we are in the world? A lot of people get left behind, right?
Yeah, so I think from an investment perspective, this is again this. I need to invest. I need to be investing. I can't just be reading about investing, reading about the newspapers. I have to be a participant in the market. So I have to feel it. When the market's going down, I have to feel that pain. I have to feel that anguish and that anxiety. So it's almost like I have to have that kind of that connection to what's going on, and that's how I stay engaged. That's how I stay curious. That's why I just have a daily flood of questions that I don't have answers to, that I want answers to, and therefore that's how I spend my day trying to answer as many of those questions as I possibly can. So how do you stay engaged? Just by being invested. That's it. I think more broadly, kids are great for kind of making you realize how quickly the world is changing. I've got a couple of kids, and they just do and say hilarious things, and I think that keeps you engaged with the broader world. In terms of staying relevant. Yeah.
Well, running a portfolio keeps you relevant because what you're basically saying is skin in the game.
Yeah. Oh, for sure. And this is kind of central. And this is a big Taleb thing. But another one of my heroes, Warren Buffett, always eating his own cooking. Always, I might be wrong. I could be very, very wrong. But I'm not going to sell you something that I'm not going to do myself. Right, and I think that's almost that's a bit as good a safety valve as you're going to get with any manager. Question number one: are you invested in this portfolio as much as you expect me to be? Right, and when you hear, if a billionaire's got a couple of million in it, the answer is no. Right.
Okay, next question. Some of our guests can tie their success to one key breakthrough. Did you experience a tipping point in your career?
Yeah, actually. I think the biggest, and it probably maybe it was thanks to Taleb. I don't know, but I was sitting on the prop desk at Dresdner, and I'd come down from the economics department, so I was the kind of bookish academic, didn't really know much, which is all true. The other guys on the desk were kind of seasoned traders, options traders, options market makers. They'd kind of cut their teeth in the open outcry system of life. Cash equity market makers, risk arb traders, investors, I should say. So I really kind of was the outlier. It was kind of my job, just as I saw it, to kind of shut up and listen and learn. And we kind of had this kind of conversation one Friday morning about the afternoon's payrolls and what we thought the payrolls were going to be. And we had a really long and involved debate, and it basically went something like this. I think they're going to be, 250. I think they're going to be 220. I think they're going to be 208. What do you think, Dylan? You're the economist. So I've not got the faintest idea, right? I really, genuinely, I truly don't know. You must have a view. I said, look at it. Well, what does it say on the screen? What's the market expectation? Okay, that's my expectation, right? You don't have a view. You're in the wrong job, mate. Right? That's what my the guy sat next to, who's a really, really lovely guy, good friend of mine. But he said, you know what? You're in the wrong job, mate. And I kind of thought, yeah, I I'm in the wrong job. I don't know. But then I had this kind of second thing, which is, you don't know either, right? You don't know, and therefore you're in the wrong job, by your own kind of admission. The difference is I know. I know I don't know, you don't, and therefore I think I actually have an advantage. So in a kind of strange kind of way, I think I'm kind of on the right job. So this was the kind of, this was this realization had a very kind of big effect on me. It was a moment where I realized that not knowing something didn't necessarily make you kind of fundamentally stupid. Lots of other things make you stupid, but not knowing what the payrolls are going to be in the Friday when everyone else thought they did, was actually okay. So I think this was the kind of a very big epiphany for me.
Who is a person you admire and why? Well, we probably talked about this with Richard Feynman, Nassim,
and Jim Simmons, Nassim Taleb. Who do I admire? I mean, kind of lots of people I admire for different reasons. I admire Alex Ferguson, the kind of Manchester United manager, who I think was just a brilliant guy. And he wrote a book called On Leading. And it's just there is so much wisdom in that book about how to manage a team, how to assemble a team, how to manage egos, right? How to manage a bunch of people who, frankly, are much better at doing what they do than you ever were, or than you even are, right? I think it's a kind of really important principle. Certainly in my career, when I started out my career, it was all you wanted the best mentor you could possibly have, and I was quite lucky. I had a very good mentor in Albert Edwards, who had a great time with him, but I'd known him for years before then. He's always been a very good mentor for me. But there comes a point where you don't have the education doesn't necessarily come from the guys above you. It comes from the guys below you. It comes from the guys that you hire, right? The guys, because they're much better than you are, and they're much smarter than you are, and they kind of push you, and you start to learn from them. And I think that this is very much a kind of theme in Ferguson's book. Even though they're much better than you in lots of things, you kind of discover there's some things they haven't quite got yet. So this was he built a club. He wasn't just a great manager. He built a club. I'm no Man United fan, but I think he's just an intriguing guy. I'm reading the book on the Thatcher biography at the moment, Margaret Thatcher. I think she's also a very intriguing person, a very intriguing politician. In many ways, the kind of politician I hate, which is a career politician. All she ever did was politics. And I have a real kind of suspicion of people who've never actually done a real job in their lives other than politics. But, there's always an exception. And what an exception she was. So she's a kind of fascinating character as well. I know, obviously Buffett and Mungo,
Yeah. Okay. Final question. And this is probably, you probably hold a few of these. What view do you hold that is most controversial in your professional life?
What view is most controversial in my professional life? God, that's a tricky one. I don't know. The time that I felt the most embarrassed for thinking something.
Go on.
Wasn't necessarily. It was partly to do with the context. But it was during Brexit, right? And I was at so I voted for Brexit. Okay, I was in favour of Brexit. I was one of those idiots who didn't know what he was doing, who was probably xenophobic and just didn't understand and just needed to have a rethink. Look at what the economists are saying: 6%. That's how much poorer we're going to be. What kind of idiot are you? And I think I should say it was like a line ball call for me. I don't hate the European Union at all. I can certainly see lots of benefits to staying in the EU. But it was probably 55-45 in favour of Brexit for me. For reasons really to do, we live in Switzerland. I can see how distributed power works, decentralization works. The EU is the opposite of decentralization. So the idea of taking some decision-making power from, Brussels to London, and by the way, I think it should go from London to the regions. That should be the next step, right? That was basically all, right? That was it. And I thought it was a reasonably kind of, I didn't realize it was such a controversial view. I happened to be at a conference, a macro conference with lots of people who you will know. in Lake Como, and on the day of the vote. And I think the odds going to bed that evening were, the bookies' odds were like 13%, 1-3 in favour of Brexit. And people were talking about it, but it was just an assumption that, of course, we were going to vote to remain. And then, obviously, that's not what happened. And the next morning, the whole place was just in shell shock. And I hadn't fully realised just how Remain, because this was very establishment. There were some very establishment politicians, policymakers, large hedge fund managers and asset managers, and I just hadn't fully realised the strength of feeling in favour of Remain. And literally, in about 100 people, I was the only Brexiteer, or the only one stupid enough to say so. And my God, I just got an absolute, it was actually vitriolic at times. I was like shouted at. I was an idiot. I was a total idiot. What the hell? It was as if it was all my fault. So I think. So that was the one time I thought, Jesus, I really feel like a dummy here. I really got this one wrong. I should have kept my bloody mouth shut.
Yeah, exactly. Dylan, look, fantastic to get you back. It's been a long time and far too long. I think people are going to love this. Lots of interesting stuff to chew over. Now, where do they find you because you're launching the research service? How do they find it? Find you, website, anything?
Well, probably the easiest way to get me is on Twitter, which right. Kind of sporadically, but I spend some days engaging, and then the other things, but I've met some great people actually on Twitter. I only really started using Twitter a few months ago.
Twitter's amazing. It's so powerful. That is, if you ask me the question of how do I stay relevant and engaged, it's Twitter. Yeah. It's changed my life.
It's great. There's some really, really smart people, and I think really some complete dummies as well. But that it's a kind of microcosm of life. There's some incredibly smart people. Connected and reconnected with some great people on Twitter. So I'm on Twitter, Dylan Grice, and also the company website, CalderwoodCapital.com. And I'm the people who are distributing my research is Eric. So if you people who know Eric or who have a relationship with Eric, then they can get me on that as well.
Perfect. Dylan, good to speak to you, man. Best of luck.
Thanks a lot.
All right. Take care, and I'll see you soon.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.